Namaskar and welcome everyone to Global Manthan, where we churn the oceans of knowledge to obtain the nectar of truth. Hello, Namaskar and welcome everyone once again. Welcome back to Global Manthan. Today, we churn the oceans of knowledge to obtain the nectar of truth in relation to international tax. Today's episode is called Spindle, and the metaphor is deliberate. Across the world, corporations don't just earn profits, they wind them, spin them, and route them through complex structures, intangibles, also to be lightly taxed, and yet perfectly legal. But is this design or is it distortion? Joining me to untangle and unwind this complexity is Professor Dr. Peter Hongler, an authority on international tax law, professor at the University of St. Gallen, and one of the directors of the Institute for Law and Economics at the HASK. Professor Hongler, welcome to Global Manthan.
Thank you, Ritwik, for having me. I'm looking forward.
Awesome. So, as we talked about spindle, it's a metaphor for a complex yarn, something to weave a convoluted sort of, so to speak, a web of threads, and it's in relation to corporate tax evasion, tax avoidance, tax planning, whatever you may want to call it. So when we jump in, before the thread, so to speak, is even spun, there is a loom, a fabric. That is the basic framework which we work with. Let's start with the basics. When people talk about taxes, and this is in this podcast, what we do is I offer some extreme points of view as well. When I first became aware of things like taxation and how it works, of course, everyone says tax is something you pay and has been since time immemorial, a thing to fund infrastructure building within the nation states or within the country setups that we live in. And yet, when you listen to some American conservative media and you look towards libertarianism, one of the things which really got into my head from a very young age, and which it's not like I believe in it so much, but the extreme perspective on taxation is that taxation is theft of private business owners, individuals. Why do I need to pay $40 out of the 100 that I earned to the government, right? Within this scheme of things come the concepts of tax planning, tax avoidance, perhaps even tax evasion. Could you clarify us what these three mean, and what do you think about the second certainty in life after death, that is taxes?
Yes, so first of all, taxation can also be slavery, right? And not just theft, but also slavery. That's the argument of Robert Nozick. Now, the three concepts, let me introduce them maybe by using an example. And I did not invent the example, but this is used by many of my colleagues around the world. So let's assume, it's beneficial to get married from a tax perspective, okay? It's not the case here in Switzerland, at least in general, but let's assume it's beneficial to get married. Now, if, it's decisive whether you are married at the end of the year, and you have the option to get married on the 31st of December or on the 1st of January, well, then let's get married on the 31st of December. That's tax planning, right? You have two options, and both are perfectly legitimate.
Maybe perhaps for the viewers, so the financial year, which is when tax planning is done, I think in Switzerland it is the end of the year. It's the 31st of December / 1st of January.
Yes, so for your personal tax assessment, that's decisive, yes. Yeah. So that's tax planning, right? You have two options, and you go for the one that enables you paying less taxes. Right. Now, tax evasion, that is the illegal one, that is the worst one. The example would be, you tell the authorities that you're married, but you're not married, right? You cheat. You are not telling the truth, right? That is tax evasion. And then there is something in between, which we as tax people call tax avoidance. So it's not as bad as tax evasion. So let's make another example with the same case. Yep. So let's assume you approach your roommate, right? You have no romantic relationship with her, and you ask her to get married just for tax purposes. But you get married, right?
Right.
And that is tax avoidance. It is somehow artificial, but you are still telling the truth. Right. Because you get married and then you inform the authorities that you got married, right?
Right.
So these, I think the example helps you to understand the three concepts.
True, but let's stay with this example. So from my understanding and the understanding of the viewer, in both tax planning and tax avoidance, the person, let's say me, I'm getting married, right? It's within planning and avoidance, the difference is only of intent. So when I'm tax planning, it is my intent to also get married, perhaps not only for the tax purposes. Whereas with avoidance, what I see here is that I am definitely getting married, which means legally it's fine. Yet my intent is only to avoid paying tax. So it's not a bona fide intention that I come with.
Yes, exactly. And this is, by the way, also what you see in a variety of court decisions around the world. So if the only reason why you do something, be it a corporate structure or be it getting married, is that you save taxes, then it is considered to be tax avoidance because there are no other reasons, right?
Right.
So I agree with you. Another difference is again the artificiality. Somehow what you're doing is a bit strange, right? I mean, why are you getting married with someone who you have no romantic relationship, right? It sounds a bit artificial.
Right.
So these are, I think, are elements that help you or the listeners to better understand when something is considered tax planning and when tax avoidance.
That's an amazing example. I mean, I now know I didn't have the good fortune to be a student when I was still studying here at the Haske, but I can totally understand why his students are, raving about the lectures and about the kind of concepts that they get to learn in such simple, with such simple examples. So,
just for the listeners, I copied that somewhere, so it was not my invention. I don't know where, but a colleague of mine used the example.
I heard it from you, so
okay.
I think that's all that matters. Okay, so now we move on to another concept within the fabric. We are still understanding the basics. Before we even give examples of high-scale tax evasion or high-scale tax avoidance, and just sort of to recap once again what we just learned, tax planning, perfectly legal, tax avoidance, legal, intent, perhaps in the gray area, evasion, completely black. So that's illegal. That's how I would understand these three things. Why is it crucial to understand this for the purposes of this episode? Because our focus will be on something known as base erosion and profit shifting, and the plans promulgated by the OECD, the Organization for Economic Cooperation and Development, in tackling that plan, in tackling this problem. Something known as the BEPS Action Plans, Base Erosion Profit Shifting Plans. However, what is a tax base that is being eroded in very simple terms?
So the tax base, basically, that is the amount that is used to calculate the tax burden. So you have a tax rate and the tax base. And if you multiply the tax rate with the tax base, then you get your tax burden, right? The amount you have to pay. Now, of course, if you have a smaller tax base, it reduces the tax burden. And this is why eroding your tax base can have a beneficial impact on your tax position.
Right. So from the point of view of the company that has to undergo accounting or that has to plan its tax, the idea would be to minimize the tax paying as possible.
Yes, indeed. So you want to reduce your tax base, yes.
Right.
So that you pay less taxes. Agree.
Right. And the erosion then is the more dissolution that happens of that your tax payables or payables of the amount of tax that you have to pay.
Yes, and maybe let me link it to the second term that you used. So it's profit shifting and base erosion.
Right.
Profit shifting means you shift the profits to a different jurisdiction, but you still have the profit somewhere. Base erosion means you erode your base, so somehow you have less profits. That's an important distinction. I give you an example. A base erosion would be if a country offers you a deemed deduction. So you get a deduction, although you have no costs, right? Just because you're such a good guy, I offer you a tax deduction without, that you have to prove that there is actual costs behind.
Right.
So that is a base erosion. You have less profits. And profit shifting, again, would mean you shift your profit to a different jurisdiction, but you still have the profit somewhere.
Right. Oh, that's very crucial to understand that. Because when we talk about profit shifting, this and the jurisdiction thing that you mentioned, it ideally happens in a place where the tax rate is low, right? So you go from a higher tax rate jurisdiction to a lower tax rate jurisdiction. That is the primary understanding of profit shifting and why you would do it as a company, as a corporation, or even as an individual.
Yes, exactly. This is from a tax perspective, why we use the term profit shifting to, look at cases where companies or individuals move their profits from a high tax jurisdiction to a low tax jurisdiction.
Right.
And by doing that, they still have the same profit, right? But they pay less taxes because the profit appears in a country where the tax rate is lower or smaller.
Right. And just so because we begin the journey towards understanding a high stakes example. Before that, what is the reason why ordinary tax systems or high tax jurisdictions, so to speak, are vulnerable to this kind of profit shifting and base erosion?
So the problem is and I think the focus is a bit on multinationals. So let's ignore the individuals.
Right.
So multinationals, if we look at them from a global perspective, they will have a consolidated profit. And in very simplified terms, the profit should be allocated to jurisdictions, right? Because you're operating at the global level.
Yeah.
Now the problem is, at the end, you will have a residual part. So you will have a part of the profit that after the allocation remains in one jurisdiction. And there, the planning happens. So at the end, you want to make sure that the residual profit, the remaining profit that you have from your operations worldwide, that profit is accounted for in a jurisdiction with a low tax rate.
Right.
Okay.
And the mentality behind this is not wrong, so to speak. The intention behind it.
No, I mean, and this is why we now talk about multinationals. At the end, the employees who do the tax planning,
right? They're
employed to do tax planning, right?
Yeah.
And it's the purpose still in most jurisdictions. The purpose of a company is to make profit, and therefore you want to reduce your tax burden to have a higher profit also for your shareholders.
Right.
So therefore, I think these decisions are legitimate. Yes.
Right. But ordinary tax systems have always been vulnerable to this kind of base erosion and profit shifting.
Yes, of course, a globalization has led to a situation where it has become easier to be very aggressive. Now, what do I mean by globalization? One is, of course, currency exchanges. There are not so many limitations anymore, right? You can transfer money. That's one thing. Second of all, the digitalization of the economy has also made it easier, right? In the old mortar and brick environment, it was very difficult because the authorities could see, well, there is someone selling products here, or there is someone producing something here. So we are going to tax that person. Now, with our mobile phone, we are using apps. Well, the authorities will never know which apps we are using and which company benefits from the use of these apps within Switzerland, as to use the local example here.
Yep. So basically, corporations do not need to be physically present within a jurisdiction to even employ their business there.
Yes.
Yeah. So that's the understanding behind it. And I'm starting to feel hungry, especially for a sandwich, a double Irish Dutch sandwich, to be specific.
Yes.
This is perhaps one of the most famous or infamous examples of corporate base erosion and profit shifting. Could you explain this example?
Okay. I think we should not go too much into the technicalities because it's rather complex. Right. Now, multinationals have used corporate structure to shift profits, again, as mentioned, between jurisdictions. And the most famous corporate structure in this context is a double Irish-Dutch sandwich.
Yeah.
That means, as if you were to look at the sandwich, you have two Irish companies,
Yep.
one at the top, one at the bottom, and in between there is a Dutch company. And by different transactions between the three companies,
Right.
the multinational was able to reduce the tax burden significantly because it was moving profits between these jurisdictions. And such a structure was used by a few US multinationals,
Right.
a few of the largest ones.
Yep.
And this is why it has become very prominent, not just in the tax world, but beyond. And that is the double Irish-Dutch sandwich.
Irish-Dutch sandwich. I think we can also delve a little bit into the structure itself, I think, without mentioning everything, but I think it's important for the viewers to know how this was done, right? Perhaps I can also help you in that, in terms of telling one part of the story. So let's give the example of Google, for example. Google moved $24 billion in 2017 through this method. And it was very creative and really pushing the boundaries of what is constituting tax evasion or what is tax planning, fair tax planning. So there was one Irish company, Google Ireland Corporation, which was set up. And this is where I would need your help as well in refreshing my memory, which was then routing its profits to the Dutch company, which was then paying a royalty payment for IP, for intellectual property logos or something of the sort, to another Irish company, which was actually not resident for tax purposes in Ireland, but rather somewhere in the Caribbean, the Cayman Islands, where you have effectively 0% tax rates. Is that the correct example, or am I missing something here?
No, I think that's not too bad as an explanation.
Not too bad.
Now I think what is important, the Dutch company.
Right.
The Dutch company traditionally was kind of an IP box. What is an IP box or a patent box? That is a tax privilege for companies that only have royalty income or royalty-like income.
Right.
So that company was already earning royalties. Huh? And then it had to pay parts of the royalties back to another company, the one, again, in Ireland, which is not an Irish resident company.
Right.
Yes.
Right.
And by doing so, you could, lower the tax base of the first Irish company, which collected the revenues. It was streamed to a Dutch company, which benefited from a tax privilege. And then it was transferred to another Irish company, which, did not really pay taxes because it was offshore from a tax perspective.
Right.
Okay?
Right.
But now, let's assume, this is the general framework. Of course, all multinationals have used slightly different forms of that structure. But I think for the listeners, what is important that that is one reason why historically, but still now, if they receive services from a large digital supplier, often an Irish company is the counterpart, right?
Right.
If you place a Google ad, it might be an Irish company that sends you an invoice.
Yep.
I have not checked it whether it's still today, right?
Perhaps.
Or if you, I don't know, if you download or if you buy an app on a digital platform, check where the supplier is. Often they are resident in Ireland.
Right.
You know,
Ireland being a low tax jurisdiction.
I mean, Ireland has a corporate tax rate of 12.5%, but which is low. But there were specific tax rulings involved. Double resident companies or dual resident. So it's very complex. This is why, if we start to scratch at the surface, we will need 2 hours to discuss the exact case. True. So it's not just a low tax rate, it's also that you had the possibility to play a bit with the system in Ireland.
Which is why this system became so infamous, and for many years during the 2010s, or let's say the latter 2000s, Facebook, Apple, Google, all of these big multinationals from the US were using this specific route to save billions in tax payables. And these structures, even when we talk about the modern day, they haven't collapsed as such, but they have been redesigned, so to speak. However, we discuss now what happens when authorities get a chance to look at this complex spindle, this complex thread that are being spun by these multinationals to hide their profits or to erode the tax base and shift their profits away from the absolute jurisdiction of the tax authorities. This is where the OECD, the Organization for Economic Cooperation and Development, came in. And they said, okay, look, this has gone on for too long. We have now finally caught up to the kind of practices that the multinationals do. And we come up, well, in the early 2010s, the first action plans. And very recently, as recent as 2 or 3 years ago, they came up with Pillars 1 and 2 of the BEPS 2.0. If the audience wants to understand in simple terms what these action plans were and what they did, perhaps.
Okay, so yes, the first important distinction is between BEPS 1.0 and BEPS 2.0. Mm-hmm. So BEPS 1.0, the final results were presented in 2015, so already 10 years ago. Huh?
Right.
And it was an action plan consisting of 15 different actions.
Right.
Some of them were mandatory for the countries that were involved at that time, and others were not mandatory. Some of the measures were tax treaty measures, and others were measures for the domestic law, right? Mm-hmm. And so if we look at these different actions, we see that some of them have now been implemented in many jurisdictions, and others, there we have not really seen a change, right?
Right.
So I don't know, should we now talk about a few of these actions, or should we now move already to 2.0?
I think 2.0, because it also talks about the global minimum corporate tax rate, which is something that has been talked about a lot. Perhaps for the viewers, it's also important to understand that the OECD, however, has only 38 member countries. However, these action plans, which have been suggested, are also being adopted by other developing and emerging economies. Mm-hmm. Why would they do so, even though they are not members of the OECD or are perhaps observer member states? The reason being 100 to 240 billion US dollars in annual tax loss for countries has been occurring due to these base erosion profit shifting, which is close to 4 to 10% of the global income tax revenue. The burden has been felt more prominently or profoundly by the developing economies. Let's say, take the example of the global south. For example, I come from India. In India also, there are large-scale political ramifications of this tax base erosion. And people, whether you talk about individuals or multinationals, it's really frowned upon. And political ramifications, meaning that governments who fail to effectively tax corporates will then be seen as being colluding with those multinationals or with those businessmen who are harming taxpayers' money. So you see where my intention is coming from to discuss why it is so important and so crucial to understand these action plans. Perhaps here we can talk about the BEPS 2.0 and how it takes the fight even further.
Okay, so if we start from BEPS 1.0, a key element was not solved. And the key element being that multinationals pay taxes in jurisdictions if they are physically present. Mm-hmm. That is still the system that we have now since 100 years. Huh?
Yeah.
And first, people thought that BEPS 1.0 will solve the problem, that maybe we will move to a digital presence, right? That a digital presence is sufficient.
Right.
But countries were not able to reach a consensus within the BEPS 1.0 project. So that triggered a lot of frustration within some jurisdictions.
Right.
Because again, you have mentioned some names, Google, Facebook, Apple. So their digital services, we are not able to tax within Switzerland, within France, within India. Mm-hmm. following the traditional concepts of international tax law. Again, being, you need to have a physical presence. Yes.
Yep.
So this is why countries started BEPS 2.0. And BEPS 2.0 again has two pillars. This is why it's called the two-pillar solution. Yep. Now, the pillar one, that is the one on the digital presence.
Right.
So countries wanted to change the system and said, look, the market states should get parts of the pie.
Yeah.
So if you take the multinational profit or the profit of a multinational as the pie, the market state should get something. Because now they don't get anything if there is no physical presence. Exactly. That is 1.0. And then somehow during the process, that's pillar one. And then somehow during the process, pillar two popped up.
Yeah.
Which is this famous global minimum tax.
Yeah.
So the goal of that project is completely different. It's not about taxing in the market states, but it's about achieving a 15% minimum corporate income tax rate for all multinationals.
Right. Okay. Just by hearing it, and pardon me if I push you back on this one, because a global minimum corporate tax rate, it's kind of unheard of. And to come up with this blanket number of 15%, how did the countries agree to it? And do you know whether this is being implemented across the board, or people already have hiccups to, think about levying 15% minimum tax on corporations?
So it's a historic project. Historic in a variety of senses.
Yeah.
First of all, it's historically complicated.
I can imagine.
Unseen.
I can imagine.
Unseen.
Yeah.
We still don't know whether the whole project will fail. Yeah. Currently, it is implemented, yes.
Right.
Especially by the European countries. So they have implemented the full set of rules. There are different rules. There are easier rules and there are more complicated rules with more impact on other jurisdictions. The European Union has implemented all measures. And then there is other countries like Switzerland, which has implemented the minimum tax, but not all features of the global minimum tax. And then there are other jurisdictions like the US or China. These countries have not taken any step yet. Yep. So it's reality, it's historic, but it's also, a very special project, to be honest.
Historic in this context doesn't necessarily mean it's plausible, which is what we're finding out.
Yes.
Where do countries which were traditionally considered, what's the situation, and this is perhaps the last question of this segment, and then we move on to the next one. What was the effect of the BEPS action plans on traditional haven countries like Ireland or maybe Switzerland, as it used to be in the past?
So one effect, I think that it has really become reality is that you have tried, you as a multinational, you have tried to consolidate a bit the substance. Because the most aggressive forms of tax planning, they are not anymore appreciated by most jurisdictions.
Definitely.
By most aggressive form, I mean letterbox companies, right?
Yeah. Shell fronts.
Shell companies, yes. In the old days, you had really a letterbox on the Cayman Islands, right? And that is not anymore. That first of all, of course, it's not legitimate, but also in practice, you don't see these very aggressive structures anymore.
Right.
And here, the BEPS project has had an impact.
Right.
So companies have tried to consolidate their substance, but if you have substance, so substance means you have people, right? If you have people in a jurisdiction, it's difficult to argue for the authorities that you should not have profits in these jurisdictions, right?
That's true.
So let's talk about Ireland and Switzerland, both countries with low tax rates. So some Swiss cantons have also around 12%.
Yeah, Zug, maybe.
Yeah, kind of the same. Yeah. So if you have people in Zug, if you have people in Dublin, well, there should be profits, right?
Yeah.
And I think this is something that we have seen, that some of these countries have received more profits in some structures because multinationals have consolidated their substance in these jurisdictions. So that's one interesting aspect.
Yeah.
But of course, also, countries around the globe have become more aggressive because they have understood now what is going on or what was going on.
Right.
It has also led to a lot of transparency in the sense that authorities are nowadays well aware of the most, not interesting is the wrong word, the most, the widely used tax planning instruments, right? Mm-hmm. Maybe 15 years, 20 years ago, there was a lack of know-how.
Yeah.
That authorities did not really know what was going on at the global level. Right. And now I think they're more aware of the traditional structures and they challenge them on a regular basis.
And perhaps a change in political will as well. I heard this recently from someone that to make a change in democracies or political economies, the main element there is sometimes political will, right? So perhaps countries are not only listening to their constituents, but politicians are also thinking, okay, this is a practice which is not only unethical, immoral, or illegal even, but it is going to have serious repercussions if they want to stay in power. And that's kind of what generates that political will within those jurisdictions and within those countries as well to change things. So what you're saying is that there are definitely encouraging signs since the BEPS Action Plan, even 1.0 came in, and with 2.0 they are going after the digital services, which is even more, or the digital presence of these multinationals, which was really, really needed, considering how different the marketplace looks like now versus even 15 years ago. We move on to the second last phase of our discussion. What is legal is not always ethical, and what is ethical may not be enforceable. How far is too far when we talk about the profit shifting? And this is perhaps a question that I also asked you in the beginning, but let me ask you now in a more, so to play the devil's advocate now. Should we really blame corporations for using the tools or loopholes that they exploited within traditional tax jurisdictions? Because the idea, and this is sort of me invoking my inner Ayn Rand, isn't the idea of capitalism or capitalist economies to maximize your profit and keep it for yourself because the companies have worked hard for it?
Yeah. So and let me again get one step back and maybe challenge a bit the narrative that you have brought up. There is 200 billion missing and we could do so much good thing with the money. I would be careful to make such an argument. Huh?
Right.
And the main reason being that the effect of additional taxes is really dependent on what governments do with the money. And I think that narrative has largely been missing in the debate in the last years.
Right.
So the narrative the last 10 years was probably very much on, yes, we need to challenge aggressive tax planning schemes, etc. But we have forgotten that, we need to have a serious debate about what is the reason countries spend the additional tax revenue. And does it really have a positive impact?
Uh-huh.
Let me give you one example. In Germany, they have a fiscal problem because their pension scheme is so expensive.
Mm.
And it's not just due to demography, but one reason is that the whole pension scheme needs to be funded basically through the government, right? Mm-hmm. In other jurisdictions, large part of the pension scheme is funded by the individuals itself, right? You create a regulatory framework that allows that. Yep. But if the country needs to pay all retirees, it gets very expensive. And then, you need additional money. And so I think that debate is important here. Mm-hmm. And therefore, I would be careful to argue that, well, let's put more pressure on the multinationals because everything we can extract from them will have a positive impact. No, it will not.
No, it will drive them away.
First of all, it will of course decrease growth, and here I'm a capitalist as well.
So you agree with me? Then.
Yes, I agree with you. So it will decrease growth, but also important is to understand the positive impact depends on what countries do, and that brings me to your ethical point. That depends a lot on where you were born, how satisfied you are with your government.
Right.
Because it can be ethical not to pay taxes if your government spends the money for a senseless war.
Or corruption.
Yep.
And
it can be perfectly ethical to challenge tax planning if the money is spent by a government that only does good things. So I think we should never forget that within this debate.
And this is important because I was reading the OECD when I was preparing for this podcast, for this episode as well. Even the OECD acknowledges on the very action plan side that most forms or many forms of profit shifting are actually per se legal. So why even bother with these action plans, right? But as we understood through our conversation so far, this was really coming to a head where it was hurting the taxpayer as well. Because when you see your money going, or let's say money which was meant for infrastructure projects, social schemes such as the pension scheme you mentioned in Germany, and it's being routed elsewhere, or the government is really having to work for it, then that is the cause of this fracture within government, society, people, and multinationals, which leads to this situation.
Yeah, I agree, but again, we should be careful because often you hear the argument, look, the money could have been spent for schools, right? The money could have been spent for hospitals.
Yeah.
Well, that's only partly true, right? I mean, that might be the case in a governmental situation where the government works efficiently, where there is no corruption, where there is no spending which is not necessary if you restructure your governmental setting. Like the pension example.
Yeah.
So I think that is a serious debate we need to have. And the problem is in many jurisdictions, we have reached a level where the tax burden is probably at its limit, right? If you need more than 50% of your GDP through taxes, that is a huge pressure for the whole population.
Definitely.
And so probably in the next years, we see, there are more pressure that countries realize we cannot finance that. I mean, the US is different because traditionally they still have a smaller state. But if you look at some of the European states, I mean, they have run out of ideas to fund their governments because it has become too expensive.
Right.
In the US, we would still have the option to implement a VAT, a value-added tax.
VAT. Yeah.
Yes, that's possible.
And that's also common here in Switzerland and in European jurisdictions as well.
Yes.
Yep.
So we have an individual tax, we have a high VAT, we have a corporate income tax. More than that, you cannot really do. I mean, if you don't want to have too many negative impacts on the economy.
Final segment and final set of questions now. Is tax planning as we knew it, or as we discussed here, also a thing of the past? Because I heard recently, and whenever you read newspapers these days, you talk about haven assets and not haven jurisdictions per se. So you talk about crypto, you talk about real estate investments or IP box regimes, which was the thing of the past, but more likely crypto. Is hiding money or profit shifting really moving into a different dimension now?
So now maybe let's focus on individuals, because when you talk about crypto, we mainly talk about individuals.
Right.
And definitely, cryptocurrencies in the past or for the past years have been used for tax evasion, not just tax avoidance.
The worst kind, the illegal stuff. Yeah.
And then, evasion is really undermining our governments and our state structure. So then it becomes dangerous. And here, I'm the first one who is all in for regulation to avoid tax evasion through these new instruments. Yep. But tax planning in general will always be there, right? I mean, if there is a tax system, there will be tax planning.
Yeah, the more elegant the design, the harder it is to see who spun that.
Yes, I mean, funny example, the global minimum tax. I know many advisors, they told me, great, finally we can again do tax planning. No, because it's true, you create a new regulatory environment and it opens again the box with planning opportunities. But that's normal. Yep. And we should understand that is not surprising.
Right.
But what should bother us really is, as you mentioned, new features where you can commit tax evasion.
Right.
And cryptocurrencies are an example for that. So we need to have rules in place too.
Even gold, like traditional commodities which we think of, they are also termed as haven assets for that purpose itself. Because you can invest in them, you can hide money which was supposed to be taxed and just go forward with those evasive practices as well.
Yeah, it's easier to trace, right? In the crypto world, sometimes you really have
It's-
problems to trace.
Definitely. Despite the fact that the system it is built on was built actually to build better traceability, which is blockchain.
Yes.
And yet it's being used on the other way. So people who are crooks or criminals are always 2 steps ahead,
Yeah.
as the saying goes. One final question, and this is perhaps also for a younger audience, maybe perhaps your students who might be listening. What is your vision of a just global tax system?
Okay. What is my vision of a just global tax system? I mean, first of all, countries should be able to tax what happens in their jurisdiction. Full stop.
Yeah.
And this is why I have been an advocate for a digital presence test, that we can tax large multinationals if they are only present digitally, right? So I think that's important. We need to get rid of the old doctrine that there needs to be a fixed place of business, a physical presence. I think that's important. Second of all, we should be careful that we push other countries in a certain direction.
Right.
And here I'm very critical of the global minimum tax.
Yeah.
Because if countries want to abolish their corporate income tax, they should do it. Maybe it's a good idea. Because, the corporate income tax is very expensive, and a lot of tax planning opportunities, etc. So we need to be careful that we are not, through global regulation, force countries to do A, B, C, D. Because it infringes also the sovereignty of other countries.
Absolutely.
So we have twice a sovereignty problem, right?
Yeah.
And the last one, of course, we have humanitarian duties. I call it humanitarian duties.
Yeah.
This is different from distributive duties. So we need to make sure that in countries where we have humanitarian problems, that we fix the tax system there, and we do not undermine it through our policies here.
Right.
However, global trade, 90% happens within the developed world. So there we often don't have humanitarian duties cross-border. Okay?
Right.
These are my 3 elements.
Amazing. That is a beautiful message for the viewers to take home with. Professor Hongler, thank you so much for your time and for your expertise on this topic, which I believe is definitely a topic where we needed to churn from both sides to understand what is really going on in terms of base erosion and profit shifting, and what are the ways to actually untangle, unwind, and go for the spindle that weaves the thread. To the viewers, in today's episode, we followed a thread from structure to strategy, from law to ethics. In a world where profits and taxes are almost as certain as death, the most powerful corporations are often the most creative. Thank you, Professor Peter Hongler, once again for your clarity and your candor. And to the viewers, keep spinning your questions, because you're the first thread of this fabric. And the idea is to prepare a beautiful, well-knit world. Until next time, and stay tuned to Global Manthan.